Hello, this is Dr. Tara Van Zandstern with SSD Global Solutions, Smart, Simple Decision Making. We're the sponsors of the Rocky Mountain Quality Consortium, and my guest today is Brian Higgins of Resource Technology, who will be speaking today on transformational lean financial planning and analysis. Welcome, Brian.
Well, I'm very happy to be part of this conference, and I hope the audience enjoys what I have to present today.
Well, I'm sure they will. Brian is the principal at Management Resource Technologies, and he has 25 years of progressive experience in the field of financial and operational performance management, as well as quality improvement. He is a nationally recognized leader and researcher in the development of advanced performance management systems, and he's actually been honored by receiving the best practice recognition from the American Quality and Productivity Center. Mr. Higgins has authored a number of articles and is frequently a speaker at national conferences, universities, professional organizations on the topic of advanced cost and performance management. We are so pleased to have you here today, Brian, and I'm going to hand it over to you and let you tell us all about transformational lean financial planning and analysis.
Well, thank you very much. First of all, I'd like to start with a little bit of my background. I'm going to repeat a little bit what Dr. Stern had indicated, but I go back for many years where I specialize primarily in the application of lean and performance improvement techniques that are financially based and really work with organizations to improve financial and operational performance. And so I go back also to my days as a consultant with Deloitte. Spent a number of years with First Data Corporation as an internal consultant in all matters related to improving financial and operational performance. And with that, I'd like to give a little bit of an introduction into the topic today and step back and look at just what are those challenges that go on within a lot of organizations today. They've got pressures on performance, changes in business environment, and there's a whole host of things that are driving organizations today to improve their financial and operational performance. And last but not least, I think I want to talk a little bit about the diagnostic that is sometimes missing when organizations plunge forward into performance improvement. Sometimes when they identify opportunities, those opportunities may be based upon intuition or noise, or what we used to refer to as the squeaky wheel. I'm going to discuss a little bit about how organizations can first diagnose their operational performance and then use that information to identify the specific areas that require corrective action, and they can focus their improvement efforts in those areas. Now, one of the things that is important is the role that finance can play in performance improvement. And oftentimes there is that sense of urgency, which based upon institutional investors, especially activist investors, they now are pressuring organizations today to produce exceptional financial results. And most organizations are really facing that, yet at least there's been some studies to indicate that at least 1 out of 3 strategic initiatives tend to fail in the finance community. But I also want to share with the a study that was done by the American Productivity and Quality Center regarding how finance personnel apply their time in the business. And one of the things that this question or this survey asked was, what are the most vexing barriers to improve financial planning and analysis in their business? And the results really were quite shocking to many people. As finance people or as CFOs, which was the target for this study, they found out that a great deal of their time is buried in basic duties. Let me kind of expand upon this a little bit. 62% of the people said that they were just caught up in the financial responsibilities of a CFO and really did not have time to concentrate on financial planning and analysis. While half of that group, again, indicated that there was insufficient access to operating metrics. I think what they're saying there is that although they're responsible for the financial performance and reporting financial results, they don't have, in many cases, the metrics on the operations. In other words, what the organization is producing or the services that they provide. They also are not sufficiently knowledgeable about the strategy of the business. So sometimes they're out of the loop. And 19% reported that it's really not a management priority to improve financial planning and analysis. And yet at the same time, as mentioned earlier, investors and management is putting pressures on the financial community in those businesses to improve performance. But I think that one of the things that we really want to stress in this presentation is finance people, like others, they really have to get a seat at the problem-solving table. Let's talk first of all about what we call conventional cost accounting. And this is an analogy. Now, finance people work a lot with numbers. They try to understand the cost of doing business and the like. But in many cases, the cost accounting systems that are there to help them understand the financial performance are really not adequate for the purposes of performance improvement. Let me give a story here, which I think some people might relate to. Assuming that you went out to lunch with a lot of people. In this case, Jill joins 9 of her friends for dinner, and they all order the special, the $50 special, except Jill decides to order the $10 appetizer. So they all decide at the end to split the tab. And as a result, they each pay $46 a piece to cover the bill. Well, what's interesting then that means Jill or others who ordered a less expensive dinner are really going to subsidize those who bought expensive dinners. So she would be covering or subsidizing the cost of the other diners, of course. Now, the question is that really fair? And we all know that isn't fair. It's not fair for some people to subsidize other people's lunch, unless they all agree to it and they're all friends about that. So the interesting thing is that many of today's businesses actually cost their products and services in much the same manner. In other words, they will use a lot of averages when they cost out their products and services. Management relies heavily on the accuracy of cost for decisions that they make regarding financial and operational performance, and even the selection of the projects that they work on to improve their financials. But to impact costs must first be understood. And as this example shows, is that cost accounting systems really and oftentimes do not tell a very accurate story about the cost of products and services that they provide. So in other words, conventional costing methods rely heavily on averages and pooling of cost and allocating costs out. In many cases, for example, the overhead and indirect areas of an organization are pooled, and then they're allocated out to the various lines of business, oftentimes, for example, based upon revenue. So those lines of business that create more revenue end up with being assigned more of the overhead cost, whether or not those lines of business actually use those costs themselves. It's just a convenient way of covering all of the cost. But what's needed is first a system that treats all cost as direct, eliminating those cost pools and averages and so forth, so one can truly understand the cost of the products and services, and then use that information to assess the value of the products and services that they provide. But what happens, though, if the cost accounting is not correctly done? It's based upon an average. Well, as the graph shows, if one uses an average cost, for example, there's going to be some areas of overcosting and some areas of undercosting, because the costs that go into that pool may not represent any exact cost for any line of business. Some lines of business are going to use more of that overhead or indirect cost, and others are going to use less. But what's common is to assign some kind of an average based upon a rate. But what really happens in the organization when pooling and averaging is used? First of all, some lines of business may be undercosted, where the line of business consumes a lot of resource and cost, yet is being reported as being low cost. And that happens when costs are not properly assigned. But as a result, pricing for those products and services may be too low, and therefore you've got a profit loss. At the same time, the opposite occurs is when lines of business, or the products and services that the organization produces, are overcosted. A line of business actually consumes a significant or insignificant amount of resources, and yet it's being reported as having high cost. So in that particular case, those products and services may in fact be priced too high, sacrificing revenues. So it's very important before organizations go down a path of looking at performance improvement is to really understand the true cost of products and services. There are also some roadblocks that occur in performance improvement. Lack of management involvement and commitment, the lack of buy-in or engagement by the affected areas that are being performed. Some people think that, that I really don't need to improve what I'm doing. So there's a whole host of things that get in the way of organizations to improve the things that they do. Sometimes they overextend the staff. But all of these conditions make it very important to select the proper projects to work on that'll give you the greatest return on investment. And as mentioned earlier, a lot of those selections are based upon the squeaky wheel or inadequate information about what things really cost and the issues that organizations are having. So what we prescribe is basically finding out ways to what we call dislodging the status quo, which overcomes resistance to change, giving people a reason to change rather than simply hoping that if we collect enough information, it's going to change by itself, which doesn't always occur. So dislodging the status quo is extremely important. Dysfunctional costing systems, we talked about that before. And so one of the roadblocks is, again, not understanding what things really cost in the organization and what issues there may be associated with the value that's being produced or provided to the customers or the users of the services. And then again, as I indicated previously, is the selection of projects to work on for performance improvement is not always based upon the best information. Okay? So one of the things that we prescribe is kind of a job plan or an addition to the DMAIC approach. Now, we're all familiar with define, measure, analyze, improve, and control. This presentation is we're going to really focus on an element that sometimes is missing in quality and performance improvement, and that's the diagnosis. To first say, what is going on in the organization and what works and what doesn't work. And once we understand and diagnose the organization's performance, then it makes it easier to define what the problems are and continue with the rest of the DMAIC plan. Okay, and also sometimes there are some restricted areas in Lean and Six Sigma. Not in all cases, but in many cases that we've seen, there are some areas that really are what we call being off limits. And some of those, and some of those might include costing. In other words, when Lean and Six Sigma teams get together, they oftentimes rely on the cost provided to them by the cost accounting department or the finance organization. Now, if they're not applying costs correctly, as we shared previously, that information could be in error, and therefore these teams are going to be chasing down opportunities based upon faulty information if they base it on cost. Also, too, they don't often get involved in pricing. That's someone else's responsibility. So Lean and Six Sigma teams may look at processes and elimination of waste, but they often don't look at, are we pricing our products and services correctly? And in the methodology that I'll cover in this presentation, I'm going to show you how important it is to have adequate or good pricing based upon the value. Compensation, for example, is another area that often is off limits to Lean and Six Sigma. Yet at the same time, we might find out that there are different compensation plans, or there may be people being paid more or less than what's actually required of the job. So sometimes we find out, for example, that perhaps highly compensated employees may in fact be doing work that could be done by people who are less compensated. And that is actually a form of waste, or a lean tenet about identifying waste. We're talking about the waste in the utilization of human resources. Service and product offerings. And again, most teams don't say, well, here's the products we should add to our, or products or service we should add to our menu, or these are the products and services that for one reason or the other we should eliminate. Because I think one thing that's important with any performance improvement program, especially Lean and Six Sigma, when you're looking at processes, some processes shouldn't be performed at all. It makes little sense to do something or improve something that shouldn't be done in the first place. And so when you look at the diagnostics, that's going to uncover those areas of here's a particular product that we really shouldn't be offering in the marketplace anymore because we can't compete. Product features and benefits, very similar to the previous bullet. And again, these teams don't often discuss or recommend changes in features and benefits in the products and services. Organizational structure, that's a key one. Usually we leave that up to maybe human resources or some other group. But the organizational structure, as I will show in a case study later on in this presentation, actually had a significant impact on the financial and operational performance of an organization. Cross-functional units. There's a number of these things that sometimes are off limit, but also provide an opportunity for significant improvements in operational performance. Let me go on a little bit more here with the job plan that I'm presenting today. The methodology we're talking about is something called activity value management. It does focus on the activities, but rather than focusing on cost, it really focuses on the value and managing the value of the products and services that are provided. It is a proprietary system that is lean-based and looks for waste in organization, but not just the waste in a typical way, but waste in how resources are used, how everything in the organization may contain some element of waste that can be identified and eliminated. It has two major components. The first one is what we refer to as a revolutionary costing philosophy that directly assigns all cost and effort within the organization to the processes, activities, and lines of business without using any allocations, aggregation, or pooling of cost or averaging, as we showed earlier in this presentation. And it focuses on looking at processes and activities, financial performance, and what we refer to as experiential results coming from customers and employees regarding how well the activities and processes in the organization are performed and the value of the resulting products and services. So in this case, in addition to assigning costs to the things that are going on in the organization, we would capture qualitative or experiential data from customers and employees, and that also gets linked back to those same activities. So now you can determine what does an activity cost and how well is it being performed. This diagnosis will tell you specifically what needs to be changed in the organization and what it's worth. And if you do those things, you're going to be increasing the value of what you do to your customers and your employees. And we think of this in a way, this way of thinking is like looking at a stream that has, for in this example, some fish in the stream, and you can barely see where the fish are. But by putting on what we refer to as the AVM lens, we can now see below the surface and see all of the fish in this stream. And looking at the organization in the very same manner, doing a diagnosis that looks at process, activities, cost, and what the stakeholders feel about how well you're performing, uncovers all of the issues and concerns within the organization, rather than those simply larger issues that kind of float to the surface. Now, there's a quote that I sometimes use that exemplifies what I'm referring to, and that is by Henry David Thoreau, who said, "It's not what you look at that matters, it's what you see." And by having a good diagnostic tool before you start employing the performance improvement techniques or the quality improvement techniques, you're going to be much more productive and you're going to improve outcomes. And this methodology, as Dr. Stern indicated before, was designated best practice by the American Productivity and Quality Center in a nationwide benchmarking study. Now, the objectives of AVM are first to diagnose performance while capturing the true cost and profitability. And that's done by defining all the organizational processes and activities. We're going to capture all the cost, both direct and indirect, and assign it to the processes and activities. We may determine what the actual profitability levels are of the various products and services and capture that experiential data from the stakeholders, which I think is extremely important and oftentimes missing in a lot of improvement efforts. Then we're going to use that data to improve the productivity, performance, and profitability, along with resource utilization of the organization, by linking that data together and identifying those processes in which there are cost issues or performance issues or feedback from customers and employees that might indicate that that's an area that requires improvement. And another thing that's important when we do this work is the transfer of skills to enable internal, in this case here, FP&A teams to drive further improvements in the future, to continuously apply these tools and techniques. Then the question is, well, how is this done? What is the timing? Well, first of all, this is an organized approach using what we call a cross-functional internal team of employees. By that we mean there should be some representation from all of the major functions that go on within the organization. May not be full-time, but we do want some input from all these different groups. And what they're going to do is go through what we call a job plan. And this is both a diagnostic and prescriptive approach to uncovering really breakthrough opportunities. Now, in phase one is the diagnostic, where we have the planning phase, which is defining the activities and processes in the organization and capturing the organizational costs. Then we're going to collect the data that relates that cost to those processes and activities. Now, at this point, we're going to have a database of information that includes the cost of everything that goes on, the profitability of the products and services, what all the employees in the organization are doing. Some of those things might be related to what we call mission-related activities versus non-mission-related activities. And then we're going to synthesize that data, sort it out, look at it, and then determine out of that collection of information We're going to synthesize it down to say what are the select few areas that we're really going to go after that have the potential for the greatest financial and operational impact. Then we get into what we call the prescriptive phase, where we do, let's call it a deep dive into those areas to get further information to justify and really map out the changes that have to be made. And once the data analysis is done, then we move into the solution step. And in that step, work plans are developed, responsibilities, timelines, key performance indicators. We set up communications to get feedback as to how well implementation is going. And all of the other program management types of tools that are used to ensure that those areas selected for improvement have been addressed and the recommendations are putting in place as designed. And of course, the last phase is basically the implementation phase where those changes are put in place. Now, normally speaking, this is a typical job plan that for most organizations, even up to several thousand people, the diagnostic and prescriptive phases can often be done in less than let's say 16 weeks, oftentimes between 12 and 14 weeks. So it's a very rapid implementation of performance improvement methodologies. Next, we're going to talk about the very specific steps in the AVM processes that should give you a little bit more detail on what those steps actually include. The first one is we're going to capture and understand the organizational information. What are the goals, objectives, and concerns that the organization has about its business? What's the structure? Who reports to who? All personnel and non-personnel expenses, and identify the lines of business or services that are provided by the organization. Then we're going to engage the department management to sit down and describe those things that they do, those processes and activities. And again, we're going to capture information, assign that information to those processes and activities, and then after we analyze and review the results, we're going to develop recommendations for improvement. Those recommendations are then passed by management to get their blessing and to prioritize those recommendations. And management at the same time can commit resources to get those recommendations in place. Create the implementation plans, and of course, what's very important is what sometimes we refer to as a post-audit, and that is to go in and measure the results, let's say within 3, 6 months, 9 months out. Some of the tools that we use, I think it's important to know that although we still use many of the common quality improvement tools, there are a number of different tools used in this methodology. And the reason we've discovered or developed additional tools is because we find in many cases those tools may be somewhat limiting. And in fact, what we refer to as you may be leaving money on the table. So there may be opportunities that are missed because you haven't analyzed or had the tools available to uncover what those opportunities are. So let me describe just a few of those, and as we get into a case study a little bit later, you'll see how some of those tools are actually applied. So it does employ numerous strategic tools, and we hope that, or we say it's taking Lean and Six Sigma to the next level. And of course, we get very heavily into financial analysis, stakeholder issue analysis. When we talk about capturing information from employees and customers, we're not just trying to find out what the organization is doing well, but we're also trying to find out which things are not being performed well. There's activity scoring. That is a very interesting tool where you can score the activities and processes in terms of their importance or the alignment to the strategy of the business. And the other criteria for scoring is the performance. So you can identify which processes and activities either align or do not align with the strategy of the business and measure how well they're being performed. As you can see, we've got a whole host of different tools that can be added to the improvement methodologies of Lean and Six Sigma. I'm going to talk, this is a little difficult to see, but let me explain this. Let me blow this up first. One of the things we do is we create those activities, and then we identify the lines of business. And those activities can be laid out in terms of what we call verb noun in a hierarchical format. So it shows the actual processes being performed and the activities contained within those processes. Then we unbundle the resources. And by that we mean one of the sources for cost information in organizations today is the general ledger. And in the general ledger, many of those cost elements are already pooled, like salaries. So the salaries in a cost center may contain numerous employees. And again, we don't want to use averages and so forth. So we're going to unbundle those resources and find out the purpose and the activities that those individual resources are performing. Then we're going to capture the experiential data, as we discussed earlier. What do customers and employees like and don't like about what goes on in the organization? And those are going to be assigned simultaneously to that list of activities and in addition to the various lines of business. So what the organization can discover is first of all, what is the profitability, the financial performance of a specific line of business? What are the activities required to provide that line of business? And what are the feedback statements that are coming from employees and customers about the delivery of that product and service? And I think what's interesting is that because there is no pooling, you can then go what we call backwards or have a reverse audit trail. By that I mean, if you see a line of business that is not performing well, you can drill backwards to identify what are the activities required to support that product or service. And you can drill back even further and say, what specific organizational resource components make up that cost? So you can define specifically where the issues are and where the organization is applying their time and cost. So this kind of information is very useful in what we call gap analysis or capability assessments. What are we capable of producing? What are we producing? Capacities, metrics. There's a whole lot of information that can come out, and having that set of activities and processes provides that repository for a whole lot of other pieces of data that can be used to improve performance. But in essence, what we have here is then the deliverables for each one of those phases. And I think I discussed this, so I'll do this quickly. In the diagnosis phase, we know the performance of the products. In the prescriptive phase, we know what changes we want to make. And finally, in the implementation phase, we know then what specific steps and recommendations we need to put in place. In essence, it really boils down to a very simple philosophy, and that is, what are the things that should not be done anymore? Now, we're not talking about improvement in terms of improving a process. We're talking about things that shouldn't be done at all. So improving those processes, especially of things that shouldn't be done, is really the ultimate in performance improvement. The next thing, of course, is what are the things that should continue to occur in the organization? And lastly, what are the things that you should do more of? The things that really drive customer loyalty and satisfaction in the organization. So other uses of activity value management information. So there's just tremendous number of different uses, and I'll go through a few. First of all, you can use it for forecasting and budgeting by activity. If you know the cost and effort for each activity, and you know how that activity might be affected in the future, which activities you're going to do more of or less of, you can easily go back and use this for a very accurate method of forecasting and budgeting. Strategic and tactical planning, the alignment of those activities to say which activities either align or do not align with the strategic direction of the organization. And those that do align, what are the tactical steps to improve the performance of those activities to meet the strategic objectives of the organization? We've had organizations use it for wage and salary administration. The next one, we talk about quantifying soft areas. This is almost impossible to do, and that is, if one were to say, how much are we paying for poor planning or the lack of communication? Well, if you can identify the activities and what portion of the activity is driven by those negative drivers like lack of training or poor communications or excessive policies and so forth, you can then estimate what the cost is of some of those soft areas. Strategic pricing, if you have better cost about what your products and services are really costing the organization, and you know what drives value for the customers, you can then get into what we call strategic pricing. Strategic pricing is based upon pricing your products and services based upon the value or the perceived value in the marketplace, not simply like a cost plus or a cost plus 10%, or pricing your products based upon what the competitors are pricing their products, but truly pricing your products based upon the value that customers get out of working with your organization. Organization analysis, audits, risk, there's a whole host of things. The last one about provides the basis for project investment is also very important, because things like IT investments, investing in ERP systems, these things cost tens of millions of dollars, yet are almost impossible to provide a return on investment. With this kind of information, you can identify the impact that the IT project will have on a particular activity and determine the financial impact, whether the costs go up or down, on every activity in the organization if that project is implemented. And that can be the basis to create a return on investment. I'm going to walk through a case study of a service organization that had some significant issues. They were a financial services organization that dealt with merchants. They were already quite profitable. However, they found that there was a $25 million profit gap between where their performance should be and where the actual performance is coming in. And that had them greatly concerned, because those profit models were always quite accurate in the past, and now they're off by a tune of about 25 million, and they don't know where they lost that profit. They didn't have a good understanding of the cost and profitability of their lines of business. They had flat revenue growth over the previous 5 to 6 years. And they had a number of customer complaints, which resulted in a high turnover or churn rate. They were losing 60% of their customers every 2 years. And of course, this had them very concerned about their ability to correct these and get back on a firm footing going forward. But what did they do? Well, the one thing they did is they implemented Six Sigma, a good program, but it was really aimed at the operational part of the organization and not really the strategic or the higher level issues of the organization. So they had a very slow start. They spent a lot of money, but unfortunately, they didn't see much of the savings going to the bottom line, nor could they really identify where the $25 million profit gap was going. Because Six Sigma, the way they implemented it, was not really a financial tool, but an operational tool. They then hired a Big Five consulting firm who spent about 6 months, and they failed to identify what they referred to as some kind of a revenue leak in the organization. In other words, the revenues were coming in, but not necessarily floating to the bottom line. They also unsuccessfully initiated something called activity-based costing, which hopefully they thought that maybe that would help them. But again, there's other costing tools out there that still rely heavily on averaging and allocations like we talked about earlier. And that didn't give them the information that they needed. They then employed AVM to reverse the financial and operational setbacks and those issues and concerns. And we're going to show how they did that. So the process that they followed was they identified almost 500 activities. They directly assigned all their costs. They captured over 2,600 statements from customers and employees. They analyzed the results and identified and prioritized dozens of opportunities, but I'm going to illustrate just one area out of the dozens that they identified, and that's customer support. And the reason I chose customer support was because of the high turnover rate and also the feedback we got from customers that were very negative with regards to having their problems solved when they came up. But first of all, I want to step back and look at the profitability. We talked about the costing concerns that they had. Well, in this particular case, we lay out the various lines of business in terms of the profitability, starting with the highest profitability items down to the ones that are losing money, okay? And in this case here, the core product line was generating about 65% of the revenues, and they had very high profitability. But the cost accounting systems, because they allocated overhead on the basis of revenue, and this had most of the revenue, it was assigned most of the overhead cost, even though that overhead cost did not really apply to this line of business. But based upon that earlier information, they then created what we call the alternate line of business. It was a more automated application of that same service. And what they were doing is they were, in fact, going to then migrate their customers to that. They were going to replace that core product line with the alternate product line. But as you can see, the core product line, because their costing wasn't accurate, this was the wrong information. They thought it was losing money, and they thought the alternate was making money. And what happened was it was just the opposite. So in fact, they started to migrate customers over to that other product line. Many people feel that should have been obvious, but it wasn't. All the systems told them that the core product line was in fact losing money or very low or declining profitability, perhaps losing money. Because they had the wrong information, they made the wrong decisions, or they arrived at the wrong conclusions. Now, what's interesting is that cost them tens of millions of dollars in profit. If the work from the alternate line of business number 6, because I can't identify the actual company, was applied to the core product line, profitability would have increased by $25 million. This was the source of the lost $25 million profit gap. So they had the wrong information, they made the wrong decision, and it was costing them $25 million of profit. We then looked at something called the cost of quality. Some of you may relate to this as well, and that is by taking all of those activities and linking it to the cost of quality categories of prevention, appraisal, internal and external failure, and finally just the cost of business, provided some really surprising outcomes. And it also provided the audit trail from the cost of poor quality to the activities and then to the resources actually involved in some of the internal and external failure. So what we looked at, of course, in cost of quality is there are some apparent costs, but there's also a lot of hidden and shadow costs associated with internal and external failure because we normally don't capture that kind of information. But what they discovered was very eye-opening to them. In this particular case, what's referred to as the cost of assurance or the good cost of quality, prevention and appraisal, was costing them about $31 million a year or equivalent to over 400 FTEs. However, the cost of failure, the things that are not done right the first time, was costing them $30 million or the equivalent of 481 full-time people doing nothing but responding to internal and external failures. This was shocking to them. But this also allows us to look at those activities that contribute to the failure cost in the organization and target those areas for improvement. Now, when we talk I stressed earlier about the importance of listening. And of course, it's a lean tenet to get information from customers. But I'd like to relate back a story or an event that occurred at General Motors. This gentleman, his name is Roger Smith. He was once attributed with the statement, "The numbers tell me what to do." And that's understandable because Roger Smith came up through the accounting organization. He was a finance person. So the financial numbers told him what to do. But if you looked at his tenure in office at GM, their market share fell from 46 to 35%, and he almost brought GM into bankruptcy in the early 1990s. So what I tend to think is that the numbers only tell you how well you've listened. And so if you get direction from your customers and employees and you follow their direction, your financials will improve. So it's not the numbers that tell you what to do. It's your customers and employees, and the numbers tell you how well you've listened. So I talked about integrating. I'm going to show you the example for this particular organization. And again, I know this is difficult to see on in the presentation. I'll expand these a little bit. But this is a listing of the cost of doing an activity and all of the comments related to that activity. Let me blow that up a little bit. So for example, and I said earlier, I'm going to select support customers because of the number of negative comments. In this case here, we found it was $24 million a year and consumed 440 FTEs of effort. We identified a couple of risks, but after we captured the information from customers, we found that nearly 500 statements were made from customers and employees regarding how well they support their customers. These statements are in fact color-coded, red being kind of bad, and green and yellow. We had different colors to really highlight the severity or the intensity of some of these statements coming back from customers and employees. And it was these statements, along with the cost, that allowed us to focus on customer support as one of the areas that we wanted to concentrate on. But let's look at something else. We talked about the importance of getting good cost data. One of the tools in that listing of tools earlier is the measurement of what we call overlap and duplication, or cross-functional analysis. And what this is a way of looking at the organization and say, what organizations are participating in that activity related to supporting customers? And we found that the two largest departments were in fact the sales organization and the operations group, where both they accounted for like 95% of the cost of supporting customers. Now, what's interesting about this, and what makes this process a little bit different than just a cost accounting exercise, is that we include effort as measured by full-time equivalent personnel. Those two components, cost and FTEs, provides an additional tool that helps you analyze where potential improvements can be made. And that is, if we look at the salaries of the FTEs employed by sales to support customers, as opposed to the cost and effort in operations, one can simply draw an analysis that says to perform these activities in the sales organization would cost roughly $70,000, whereas in operations, it would only cost about $36,000 or $37,000. The real question then is, where should these activities be performed? But it goes further than that. Why is because operations owned customer support, not sales. So sales was actually duplicating the effort of customer support because of a certain amount of lack of trust in the ability of operations to solve the customer's problems. So the customers were basically telling us, when we report our problems to customer support, they're not getting resolved. So in turn, we're going to contact the sales organization who sold us the services and let them resolve our problems. But what happens? Well, there's another tool that we use called non-mission related analysis. If we take a look at sales, for example, and their non-mission work of supporting customers, it undermined their mission of generating revenues. That's what they were doing. That additional cost was nearly $14 million to have sales do something that was not their responsibility. And as a result, they lost $45 million of revenue opportunities. And I'll show you how we calculated that. But if I were to draw this diagram about where the sales organization applies their effort, you can see that a little over 25% of their effort was in supporting customers. And that was something we did not want them to do. That was not their responsibility. They developed and maintain products and services. That's something they should continue to do. But clearly, what they should do more of is generating revenue. So the solution was quite simple. It took a little bit of time. We had to give the right tools to the operations team to resolve those issues. But what this did is it freed up the 26% or 27% of the sales time to now apply to their mission of generating revenue. That's a 50% improvement in effectiveness. That's a huge number, but the kind of number that we see very often if we have groups spend more time on what they should be doing and less time on what they should not be doing. That's the objective. Okay, that said, I talked earlier about how the organization structure itself, which is not often addressed in Lean or Six Sigma, can really impact the performance of the organization. So what we also did is calculate the span of control shown in this graph. The average span of control in this organization was about 9-to-1. If you read the books on organization, they say, well, anything over 6-to-1 is good. But when you lay it out, you can see that there were some managers that had 40, 50, up to 75 direct reports. And what we also discovered is many of the problems that were being encountered by the customers, which caused them to defect or to churn, were actually coming from those reports or those departments in which the reporting structure showed that they had high spans of control. So many of the customer-related issues were coming from the departments that had high span of control. And the reason being, when we talked to them and got feedback from the employees, is the span of control was so high that they got inadequate training, and the manager was spending their time really with the more troublesome employees and not really spending their time making sure that everybody had the right tools and training to do the job. Now, in this case study, as I said before, we only selected one area for this presentation, but there were a number of areas. For example, they had dozens of sales offices dispersed across the organization. And I talked about that many of the teams don't get involved in structuring. So they had dozens, and what they discovered was if we could shrink these dozens down to only 4 regional offices, that saved a tremendous amount of time. And because they grew through acquisition, in other words, some of the sales offices were part of other companies before they got merged in with this one, they also found that many sales offices were doing things differently. And so, like processing an order or whatever, they were being done in many different ways. By having 4 regional offices, it ensured that all the offices were doing things in the same manner. That saved tremendous amount of money. I talked about the replacing of the core product with an alternate product that was highly automated. Well, that new product, even though they priced it incorrectly and they lost money on it when they were moving customers over, really had some wonderful features. Except what they did is they almost tripled the cost of that product and gave customers a choice between the standard product and a premium product. So what they did is they started to sell their products and services not based upon some cost or competitive pricing, but on the value that it was creating. That alternate product today is one of their highest grossing products that they offer. Finally, we talked about sales compensation. What's interesting about this is they had the wrong compensation plan where it recognized or compensated the sales staff on the number of contracts or the number of deals that they closed in a month. And upon, if I recall correctly, on the 18th deal, their percentage of the revenues went up. So the behavior that they were getting is that sales was basically selling a lot of low volume mom and pop shops that were basically losing contracts and saving the larger regional contracts and the more profitable contracts until later on in the month after they've made their quota of 17 deals. Well, that was changed. This team came back and says, no, we're going to change the compensation plan to actually encourage or compensate the sales staff based upon the profitability of the deals that they sell. And as a result, profitability just climbed tremendously. So some of the financial results is that in total, we generated somewhere in the neighborhood of about $30 to $35 million of operational cost improvements, and that was accompanied by a $45 million increase in revenues, simply because we got sales doing more of what they should be doing. We got operations solving problems for customers, and customer churn was probably cut by 75 to 80%. And so in the past, when customers called in, somewhere in that range of, again, 75 to 80% of the calls had to be escalated somewhere else in the organization to get resolved. After the changes were put in place and the operations team was given the right tools, the numbers just reversed themselves. 75 to 80% of the calls were resolved by the first person they talked to. And so, given that, it was just a tremendous improvement in our operational performance. So here we kind of talk about, we eliminated some unprofitable lines of business, we shifted focus towards greater profit improvement, churn was reduced, and the real financial, what's kind of hits the bottom line was a 10% growth in revenues, 12% of expenses, which equated to about $15 million of financial improvement per every 1,000 employees in the company. And revenue growth, after being flat for 5 or 6 years, grew 15% within 6 months. Now, given that, let me get back. I'd like to ask at this point if there's any questions that you might have.
Brian, this is Dr. Stern. First, I want to tell you this was an excellent presentation. I learned so much myself. One of the items that I was particularly drawn to in the management challenge is that, businesses need to grow, but they can't afford to do it. And then all the great information on, I believe you call it the dysfunctional costing system. Do I have that correct?
Yes.
Yeah, and then I loved where you added the diagnosis section to the DMAIC model. That was very enlightening. And I don't think we do a good job in the industry doing that. I know that you speak nationally at conferences, but I wanted to know, are you available for individual consulting? Like if someone wanted to use you and they were a new client, what is your process for them to get in contact with you?
Well, the process is normally, if there's some interest in this, to contact us directly, and the information is included in the presentation. And we would then come out, visit, find out what the issues are, understand a little bit more about the organization, what the history of performance improvement has been in the past, and where there's been successes and things that were less successful. And here we go. This is the slide. Yeah, this is the slide I wanted. I'm sorry about that. And we would then assess whether or not we can be of some help. And simply then we would come in, and if they wanted to go forward and like what they see and feel that this methodology might be useful in their organization, it's nothing more than simply laying out the job plan, looking at the cost of the fees associated with it, going back with a proposal. But one of the things I think we really stress is that we don't work like many consultants who will come in and without a lot of active involvement from the clientele and collect data and make recommendations and kind of walk away with a list of changes that should be made. We actually will engage the organization to participate with us as there's knowledge transfer and the organization itself goes through this process. And it's much quicker. There's much more insight with regards to what really goes on in the organization and what works and what doesn't work. And so in that regards, we're just much more successful than a lot of more traditional consulting interventions.
Thank you, Brian. And is there a cost to that initial consultation?
No, there is no cost whatsoever.
Well,
Because,
that's wonderful.
yeah,
That's
and
that's
there is
nice
a
to know.
certain
So people
assessment we
can.
can also do. We can collect some high level data if the organization wants to share it, and we can actually help them identify whether or not there is opportunity for significant improvement. And that's all done at no cost.
That's wonderful, Brian. That's great news. Okay, thank you everyone for listening. To learn more about Brian Higgins from Resource Technology, you can go to www.rmqc.org, which is for the Rocky Mountain Quality Consortium, and his bio and information about him will be posted there. You can also contact Brian directly and learn more about Resource Technologies at www.mrt-ltd.com, and that should be showing on your screen right now. Thank you again, Brian. We really appreciate your time.
Hey, you're very welcome. Thank you.